Every country in the world has some level of debt, representing a financial obligation. Major economies such as the United States, Japan, and China hold trillions in debt. European countries and Britain also carry significant debt burdens. The total sum of global debt is several times larger than the world's annual economic output. The debt paradox arises when considering a scenario where every nation is in debt. This situation prompts the question, to whom is the world collectively indebted? Debt, by definition, necessitates the existence of a creditor for every borrower. Correspondingly, every liability must be balanced by an equivalent asset. For every obligation created by debt, there must be a recipient entitled to that obligation. Globally, debt exists as an internal system where the world is indebted to itself. Interest payments on this global debt exhibit a unidirectional flow. This flow moves consistently upward, indicating a structured pattern. The unidirectional interest flow suggests an inherent imbalance within the global debt structure. This imbalance is not random, but rather a systemic characteristic of global debt. The current debt system is not a coincidence, but a deliberate construct. Specific mechanisms have been developed over centuries to maintain this system. These mechanisms ensure that debt is never fully repaid. Governments are thus compelled to borrow continuously to sustain the system. In this system, money is created through debt obligations. Interest payments continuously accrue to those who control the system structure. Default on debts is considered unacceptable due to the potential for systemic failure. The stability of the monetary system relies on the continuous repayment of debt and interest. System operations are not covert or conspiratorial in nature. Meetings, institutional charters, legal enactments, and contracts are all part of the system's framework. These elements suggest a visible core mechanism within the system. However, the underlying principles and full understanding of this mechanism are not always clear. The system's transparency is limited by the obscurity of its fundamental workings. The massive global debt is not a crisis, but the system functioning as intended. Understanding the system requires examining its historical construction. This historical examination starts before modern national debt existed. The current debt system is the result of deliberate design, not accidental failure. During the 17th century, European kings commonly borrowed money to finance their activities. Sources of these loans included wealthy merchants, nobles, and foreign banking institutions. Kings promised to repay the borrowed funds, along with an agreed-upon interest rate. However, kings sometimes failed to meet their repayment obligations. This failure to repay constituted a default on the loan. Default resulted in financial losses for the lenders and damaged the king's financial reputation. Historically, debt was viewed as a perilous financial state. It was considered a temporary condition, not a permanent fixture. Debt was expected to be finite, with a clear endpoint. This endpoint was defined by either full repayment or financial collapse. The modern idea of perpetual national debt was non-existent in earlier times. William Paterson, initially a failed merchant, conceived a groundbreaking idea in 1694. His idea would fundamentally alter the structure of civilization's financial systems. Paterson's concept centered around the creation of permanent national debt. This innovation marked a significant shift in economic thought and practice. The establishment of permanent national debt had far-reaching implications for governance and finance. Paterson's idea laid the groundwork for modern financial systems. In the 17th century, England was engaged in a war with France. This conflict had severely depleted the English treasury. The government faced a critical shortage of funds. Traditional lenders were wary of providing further loans. This hesitancy stemmed from previous instances of government defaults on its debts. Paterson proposed a financial model involving wealthy merchants. These merchants would form a syndicate to lend a substantial sum to the government. The unique aspect of this loan was that it would never be repaid in principal. Instead, the government would commit to paying interest on the loan in perpetuity. This ongoing interest payment would be guaranteed by Parliament. The funds for the interest payments would be secured through taxation. The Bank of England was proposed as a permanent financial intermediary. Merchants would deposit gold into the bank. The bank would then lend money to the government. The government would pay interest to the bank in return. Lenders viewed loans as annuities, not traditional debts. Annuities represent claims on a nation's future tax revenues. These claims were legally secured, ensuring repayment. The principal was never repaid, creating a perpetual income stream. Banks were authorized to issue paper notes. These notes were backed by government debt. This transformed the government's obligation to pay interest into a form of currency. Essentially, the state's promise to pay was converted into circulating money. Debt was effectively transformed into money. Conversely, money became a representation of debt. Traditional finance views borrowing as a temporary solution. Inverted finance reframes borrowing as a primary driver of money creation. Increased government borrowing directly leads to the issuance of more currency. This currency injection expands the overall economy. The government debt becomes the foundation for economic growth. This model contrasts with conventional economics where borrowing supplements existing capital. A self-reinforcing loop involves perpetual debt creation. This cycle includes the constant accrual of interest on the debt. It also institutionalizes the extraction of resources from future economic activity. Economic expansion enables increased government borrowing. The increased borrowing further perpetuates the self-reinforcing loop. The British debt model was widely emulated by major global powers. France and the Netherlands were among the first to adopt similar systems. The United States also implemented this model within a few decades. Alexander Hamilton explicitly modeled the U.S. system after the British one. Government bonds have become a fundamental element of modern finance. The focus shifted from the bond's principal value to its interest stream. This transition marked a significant change in financial perspective. The predictable income from interest became the primary consideration. Nathan Rothschild revolutionized the handling of government debt. He transformed government debt into a more efficient financial instrument. Rothschild introduced increased liquidity to the debt system. He enhanced the tradability of government debt. Rothschild interconnected various aspects of the financial system. These innovations made government debt a more dynamic and accessible tool. The Rothschild family established a powerful intelligence network in the early 1800s. This network was supported by a substantial capital base. The family strategically positioned 5 brothers in key European cities. These cities included London, Paris, Frankfurt, Vienna, and Naples. This distribution allowed for unmatched information gathering and financial influence. The Rothschilds utilized various methods to obtain information rapidly. These methods included couriers on horseback for land-based dispatches. Carrier pigeons were employed for aerial communication. Private ships facilitated maritime information transfer. Britain required continuous financial support during the Napoleonic Wars. Nathan Rothschild in London played a crucial role as a financial intermediary. Rothschild was instrumental in structuring British government bonds. He also managed the distribution of these bonds to investors. This bond activity provided essential funding for Britain's war efforts. Rothschild's efforts were vital to sustaining Britain's financial stability during the conflict. Rothschild innovated by purchasing government bonds at a reduced price. These bonds were then resold to a diverse group of investors. The investor base included pension funds, insurers, aristocrats, and merchants. This process transformed sovereign debt into a widely accessible financial product. In 1815, the Battle of Waterloo marked a pivotal moment in European history. Rothschild's private courier network played a crucial role in disseminating news from the battlefield. This network was faster and more efficient than official government channels. Rothschild's couriers delivered news of Napoleon's defeat to London a full day ahead of the government. This informational advantage provided Rothschild with significant financial and strategic benefits. The early intelligence allowed for informed decisions in trading and investment activities. Nathan Rothschild employed a strategy of market manipulation following the Battle of Waterloo. Upon receiving early news of the British victory, he strategically sold British bonds. This action created widespread panic among investors, causing bond prices to plummet. Rothschild then capitalized on the panic by quietly purchasing the devalued bonds. When the official announcement of the British victory arrived, Rothschild controlled a significant portion of the bond market. Governments have recognized a fundamental shift in the control of finance. Traditional military might is no longer the primary tool for exerting financial influence. Instead, control hinges on the strategic management of information and liquidity. This transition has redefined the dynamics of power in the global financial landscape. By the 1822, the Rothschild network became central to European state borrowing. European states seeking loans had to engage with Rothschild. The Rothschild network was uniquely capable of handling large bond issues. This capability spanned borders, currencies, and diverse investor groups. Global debt has created a highly interconnected financial system. This interconnectedness means a default in one area can have widespread effects. Government bonds are now globally distributed through various financial instruments. These instruments include slicing, reselling, pledging, and collateralization. These bonds are embedded in balance sheets across different continents. Therefore, a single default can threaten the stability of the entire global financial system. Systemic risk arises when the failure of one entity can trigger a cascade of failures across an entire system. A single bond's default can propagate through multiple obligations it supports. This interconnectedness means one missed payment can escalate into widespread panic. The systemic nature of default makes it a politically sensitive issue due to its potential for widespread economic disruption. Governments have evolved into crucial components of the financial system. They are no longer simply entities that borrow funds. Governments now function as essential pillars within the financial architecture. This architecture is considered too important to be allowed to collapse. Debt has become a permanent feature, driven by both design and interdependence. By the late 19th century, sovereign debt formed the bedrock of global finance. The Rothschild family's wealth was primarily derived from interest earned on government bonds. Their financial strength was not based on traditional assets like factories or land. Interest income from sovereign debt became the dominant source of the Rothschilds' vast fortune. The gold standard imposed constraints on governmental debt issuance. Governments were restricted to issuing debt only to the extent that markets would fund with actual reserves. Market willingness to fund debt was directly tied to the government's gold reserves. Economic panics could still trigger contractions within the gold standard system. The financial system required an entity capable of generating its own money. J.P. Morgan institutionalized this role in the 20th century. J.P. Morgan became a key lender in the financial system. This lending capability was crucial for economic stability. The ability to create money was central to J.P. Morgan's function. In 1907, the American financial system experienced a severe crisis. Banks began to collapse, causing widespread panic and instability. Financial markets froze, making it difficult to conduct normal business operations. The crisis was exacerbated by the absence of a central bank. There was no official lender of last resort to provide liquidity and stability. J.P. Morgan stepped in to fill this void. Acting as a de facto central bank, J.P. Morgan convened the leaders of major banks during a financial crisis. He compelled them to combine their financial resources. The goal was to halt the ongoing financial panic through collective action. This intervention exposed the underlying fragility of the financial system. The Federal Reserve's design was influenced by key figures like Morgan. The Federal Reserve functions as a central bank. It is structured with a public appearance. The Federal Reserve maintains a private internal structure. The Federal Reserve's operations are controlled by bankers. This structure gives the impression of public oversight while maintaining private control. The Federal Reserve acts as an infinite buyer for government debt. This is achieved through the Fed's ability to create money at will. This capability stabilizes bond markets by ensuring a consistent demand. It also suppresses yields, keeping borrowing costs low for the government. Permanent liquidity is assured, reducing the risk of debt crises. Sovereign borrowing was once limited by available savings. Now, borrowing is constrained more by confidence. This confidence can be manufactured. Central bank actions and communications can create confidence. The debt-money loop describes a closed system relationship between debt, money, the state, and the central bank. Initially, debt is created, which in turn generates money within the economic system. This newly created money is then used to finance the state's operations and expenditures. The state provides a guarantee for the debt, ensuring its perceived stability and value. The central bank further reinforces the system by guaranteeing the overall financial structure. This completes a self-sustaining loop, characterized by continuous debt rollover and perpetual interest accumulation. In the 1,970 seconds, developing nations accumulated substantial dollar-denominated debt. This borrowing was often used for development projects and infrastructure. Paul Volcker's policy of raising interest rates aimed to combat inflation. The interest rate hike dramatically increased the cost of servicing dollar debts. This sudden increase rendered the debts of many developing nations unsustainable. The International Monetary Fund, IMF, intervenes to manage sovereign debt crises. The IMF's role is to prevent defaults and financial losses in the global financial system. Instead of allowing defaults, the IMF facilitates debt restructuring. Debt restructuring involves renegotiating the terms of existing debts. This can include rolling over debts, extending repayment periods, or modifying interest rates. The goal is to avoid a systemic reset by managing debt obligations. Nations sometimes surrender policy autonomy in exchange for debt restructuring. This often involves accepting austerity measures as a condition. Austerity includes privatization of public assets. Market opening is another common requirement. Currency devaluation may also be imposed. The goal is often to remain within the debt system rather than escape it entirely. The core issue arises when debt becomes unsustainable and cannot be repaid. Instead of debt cancellation, refinancing is employed as a solution. Refinancing ensures the continuation of interest payments on the debt. This process reinforces the financial system's control on a global scale. The current global financial architecture involves a continuous cycle of borrowing by governments. Central banks play a crucial role by ensuring liquidity within the system. Asset managers accumulate interest from these financial activities. Taxpayers ultimately fund this ongoing stream of financial obligations. The concept of default is framed as an apocalypse to ensure system preservation. This framing reinforces the idea that any deviation from the default is catastrophic. By associating alternatives with disaster, the system discourages exploration of new options. This mechanism enhances stability by creating a strong aversion to change. The perceived risk of alternatives outweighs any potential benefits, maintaining the status quo. Thus, the default becomes entrenched as the only viable, safe option. Globally, debt is structured in a way that creates inherent inequalities. The world essentially owes itself, representing a closed economic system. However, the distribution of debt benefits and burdens is not uniform. This unequal distribution leads to disparities in economic advantages. Certain entities or nations benefit more from debt structures than others. This creates a system where some carry a disproportionate share of the debt burden. The flow of financial interest often moves upwards in a structured system. Taxpayers represent a foundational layer in this economic structure. Their contributions form a base from which financial resources are generated. These resources are then channeled towards various entities, including asset managers. Asset managers play a key role in allocating and growing these financial resources. This upward flow can sometimes create structural imbalances within the system. The global debt system is maintained by interlocking mechanisms. These mechanisms are innovations from Paterson, Rothschild, Morgan, and the IMF. Each innovation reinforces the others, creating a self-sustaining cycle. This reinforcement ensures the stability and perpetuation of the debt system. Understanding these interlocking mechanisms is crucial to analyzing the global financial structure. A large national debt is often viewed as a crisis, but this perspective may be flawed. The current debt level could be interpreted as the system operating as intended. This outcome is not accidental, but a result of specific design choices. These architectural choices have been implemented over a long period. The debt is a consequence of deliberate decisions made within the system. Therefore, addressing the debt requires understanding and modifying the underlying system design.